Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat and London UK feed wheat. I'll start with Paris milling wheat. There are four main levels of congestion in this market. There is a narrow band between 267 even and 269.5, a very narrow band based around 260 even, a wider band between 250.5 and 255.75 that contains within it a 2013 high at 253.5 and a 50% Fibonacci line of the whole of the 2021 move at 251.75. And finally there is a wide band, quite diaphanous, between 237.5 and 247.25, within which we have the congestion from late August to early September 2021. As a note, the diaphanous band predates the August to September band. Unlike some of the other grain markets, we really only have the one head and shoulders pattern from late October to early December 2021. And I reckon I can call this one a topping pattern, as though we've had pullbacks, the overall activity since the break below has been bearish. Thus, we have a primary target X in the 255.5 area. We've also so far come close, but we're not reached it yet. However, the real thing I wanted to talk about is the three bearish patterns that have been constructed more or less since the making of the head and shoulders top. They are the lines that cover the most recent action and consist of 1. The end November to late December 2021 bearish Andrews pitchfork. 2. The bearish shift pitchfork with the same move. And 3. The late December 2021 to late January bearish Andrews pitchfork. Now, for ease of pronunciation, I will refer to these three by their number. Okay, so bearish Andrews pitchfork number 1 showed the initial bearish angular attack of the market since the break below the neckline of the head and shoulders top. However, by mid-January, this pitchfork has broken on the upside. 2 weeks ago, which necessitated the drawing of the shallower angled bearish shift pitchfork, which is number 2. This one is still in operation, though it has been breached, though not broken, both on the downside and the upside. So a question you may have is, why have I kept the original bearish Andrews pitchfork number 1 if it was broken? Well, the answer is simple. The market this week has started running down along the top of the broken upper time, which is currently at 258.25. However, this is not all. You see, the breakup over the original bearish Andrews pitchfork number 1 and then the subsequent decline has set up the conditions for the new bearish Andrews pitchfork number 3. The market is currently sitting just above the middle time, which is currently 262 even. What is interesting about bearish Andrews pitchfork number 3, it is running parallel, if slightly higher, than bearish Andrews pitchfork number 1. What also is now becoming evident is that the market is having some second thoughts about pushing lower, down through the previously mentioned congestion zone. That's between 250.5 and 255.75. All this means that we have a very, very complex series of patterns within a fairly short time frame and a narrow range. I suspect we may see some changes in retirements by the next time I read this commentary, which does make for an interesting market, unless you have to do what I do and track all these patterns and congestions. London UK feed wheat. So, I'm still using a line chart for most of the action here. That's okay. It sometimes helps with the patterns. Anyway, we do not have any head and shoulders top patterns here. Instead, we have 3 pitchforks, 2 bullish and 1 bearish, that are fighting for the soul of this market. The 2 bullish pitchforks originate from the same early September 2021 to mid-January 2022 action. They are a bullish Andrews and a bullish shift pitchfork. I will concentrate on a bullish Andrews pitchfork here, as the bullish shift has not as yet been tested. The key is the lower time, currently at 215.10. Now this has been breached, possibly broken, as we had 2 consecutive closes below it. However, I'm not willing as yet to call it so, as the rising medium moving average, currently 213.90, has underpinned this tie as support, and we've ended this week closing back up over it. These two supports, the lower tie and the medium moving average, are key to the survivability of this pitchfork. It would not be unusual to see them tested again, maybe even broken. Alternatively, it would not be unusual to see the market use them as a springboard higher, up to the resistance from the short medium moving average, currently 220.55. There's one other resistance I will detail shortly. Then the November 2021 to January 2022 50% Fibonacci line at 222.60. There's too many twos there. 222.60. And the big thick congestion band in a 227.30 area, which contains within it the 2012 high. Now, pressing down on this is a new mid-November 2021 to late January 2022 bearish Andrews pitchfork. The first bearish pitchfork I've drawn here in a while. This is as yet untested, but above we have the upper time, currently 221.45. This is a new dynamic resistance I alluded to earlier. Conversely, below we have the middle time, currently 209.65, which is close to the lower time of the previously mentioned shallower bullish shift pitchfork. These are the forces that are at play here, and they may well turn out to be substantial, as it seems the downside has some interesting supports and the top side some competent resistances. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. Here comes the final bit.